everyone, this is Kirk here again at optionalpha.com, and in this video tutorial we're going to cover Fibonacci Arcs. So this is a little bit of a variation from your general Fibonacci retracement levels, but they still use the same principles. So let's just do a little bit of background as always. So Fib calculations, they utilize a special ratio that naturally occurs in nature to help us predict points of support and resistance going forward. So the Fibonacci numbers in the sequence go 1, 1, 2, 3, 5, 8, 13, etc. So the sequence occurs by adding the previous two numbers, i.e. 1 plus 1 equals 2, 2 plus 3 equals 5, 5 and 8 is 13, 8 and 13 is 21, etc. The main ratio used for Fibonacci's is 0.618. Now this is found by dividing one Fibonacci number into the next in the sequence. So 55 divided by 89, for example, gives you 0.618. Now again, look back at some of our other videos where we cover Fibonacci retracements more in depth. So we're going to talk about Fibonacci arcs in this video. Now Fibonacci arcs are percentage arcs based on the distance between major highs and major lows, or major lows and major highs. Now typically 3 curved lines or more are placed on the chart expanding out from the major high-low at the same 38.2, 50, and 61.8 retracement levels. Now these arcs mark potential support or resistance zones after prices pull back, or watch as prices pull back after an advance. So basically what we're doing is we're taking the same line that draws from our major low to our major high, and again we'll look at this on another live example, and we're going to the 38.2, the 50, and the 61.8 retracement levels along that line. So we work backwards along the line to find these points. Once we find those points, we draw an arc surrounding that point, and it actually goes all the way around. It's a complete circle. Again, at the 50 level, we draw an arc that surrounds that entire level, and then at the 61.8, we draw an arc that surrounds that entire level as well. Now these are going to act as support and resistance, just like your typical Fibonacci retracement levels. The horizontal lines are going to act as support and resistance. So as the stock starts to sell off, you can see that it broke under here and it acted as resistance during this rally. So as the stock was rallying, it was rallying at the same rate as this arc. It was rallying kind of right along this arc, acting as resistance before it continued to sell off again. And you can see that it broke through the other couple levels. Now let's take a look at a real example here on my trading platform. This is my Thinkorswim live trading platform, and we're taking a look at Best Buy, so ticker symbol BBBY. Now what I've simply done is done the same thing except in reverse. I've drawn it from the high right here of Best Buy back in 2008 to the relative low in 2009. And you can see that, again, it's working along these Fibonacci lines and drawing complete circles. So I can move this anywhere I want, and you can see that these circles expand or contract or whatever. But again, you want to go to a relative high and relative low. Now, if you look at this, and I'll zoom in here just a little bit closer, but you can see here on my chart that after I drew this Fibonacci retracement level, going forward, you can see that the stock actually used it as a breaking point a couple times in the cycle. So as the stock was rallying, it kind of stopped and traded right along this level, then broke and fell right along this level. It traded up to it, again, broke out, and fell right along this level as well. So now you can use these on any time frame as well, these Fibonacci arcs. I personally don't like them as a reliable tool. I find that you have to be a little bit picky with your retracements as you start to draw them. Things don't exactly fit perfectly 100% all the time. So you just have to watch out for different retracement levels and different high-lows. Again, I tend to prefer Fibonacci fans and Fibonacci retracement levels over the Fibonacci arcs, but some people really like them. They're widely used on the indexes, drawing them from major multi-year highs to major multi-year lows and vice versa. So you just have to find something that works best for you. But these are the Fibonacci arcs. Again, they work just like retracement levels as far as their sequence. Their support and resistance is just an oval or a circular figure instead of a horizontal line. So as always, I hope this has been helpful, and thanks again for watching. Please take a second to share this video with any of your friends, family, or colleagues on your favorite social network.